In this lecture, we will go over the CFA Level 1 reading on aggregate output, prices, and economic growth. In the previous set of readings, we were doing microeconomics. With this particular reading, we enter the field of macroeconomics, which is the study of aggregate behavior of households, firms, and markets. This reading analyzes a nation's aggregate output and income. I say nation over here, but it could also be the aggregate output of an economy, such as the aggregate output of countries in the North American region or countries in the Eurozone. We also look at a country's or an economy's competitive and comparative advantages and the productivity of labor force. Why is this important to us as investors or as financial analysts? Investors are generally concerned about the future economic outlook of a country for investment decisions. Clearly, if we want to invest in a given country, we want to have a view on what the economy will be like. The level of inflation, unemployment, consumption, government spending, and investment affect the overall level of activity in a country. These are all macroeconomic variables, and we need to understand these variables and understand the impact of these items on the economy and on the future direction of the economy. While this is not explicitly in the course, I want to connect what we are studying in economics with what we see in other parts of the CFA program curriculum. When we talk about analyzing a company in the equity part of the course, we discuss what's called a top-down or bottom-up analysis. In a top-down analysis, when we make investment decisions, we first study the economy of a region. We also do what's called an industry analysis, and then we do a particular company analysis or firm analysis. Now look at how this connects with the material that we see in economics. When we talk about macroeconomics, we are trying to understand the economy of a country or region. So to understand whether an economy is likely to do well, we need to understand the material that we will study in this particular reading and subsequent readings, which make up the macroeconomic part of our course. Industry analysis is closely connected with the reading that we just finished, which is the reading on market structure. In fact, many things that we see in this particular reading on market structure overlap with a reading in equity related to industry analysis. And if you think about the first few readings on supply and demand, as well as on understanding a firm and understanding how to maximize profitability, that is closely connected with company analysis or understanding the state of a particular company. So the larger point here is that this material is extremely relevant for you as a financial analyst. Now coming to the specific sections of this reading, we have talked about the introduction. In section 2, we go over aggregate output and income. Again, this is aggregate for a given country or a given economy. In section 3, we go over what's called aggregate demand, aggregate supply, and equilibrium. We'll understand the difference between aggregate demand and the concept of demand, which we discussed earlier in microeconomics. And finally, in section 4, we will go over economic growth and sustainability. Aggregate output and income. Let's start by understanding these terms. The aggregate output of an economy is the value of all goods and services produced in a given period. Typically, this period would be a 1-year period. And notice that we are talking only about goods and services produced during the period. The aggregate income of an economy is the value of all payments earned by the suppliers of factors used in the production of goods and services. And let's just understand what exactly we mean by all payments. There are four broad categories. Number one is compensation of employees. This is the wages and other benefits such as pension benefits that are paid by firms to employees. In a sense, these are the wages. Rent is the rent that is paid for the use of property, for example. Then we have interest payments, and finally profits earned by business owners. So these are the four broad categories of payments. Continuing with the concept of aggregate output and income, we also need to understand this term called aggregate expenditure. This is the total amount spent on goods and services produced in an economy during a given period. And again, the period is typically a 1 year period. Here is an important equality, which is that aggregate expenditure for a given economy for a given period must be equal to the aggregate output, and that must be equal to the aggregate income. These three terms are simply different ways of decomposing the same quantity. The key aspect here, and one that we'll keep repeating, is that aggregate output is equal to aggregate income. And let's take a very simple economy where we have households and businesses. Households supply the factors of production. So simplistically, households provide labor and households provide capital to businesses. In return for labor and capital, businesses make payments to households. Those payments represent income, and let's say that the total income is 500. Then this income is what represents the expenditure. So the households spend this money, and that money gets spent, which means it goes to the firms, and in return the firms offer goods and services. This simple illustration shows that the total output produced by the firms must equal the aggregate income. We now come to the question, what is GDP, or gross domestic product? There are two definitions which are equivalent. The first one is that GDP is the market value of all final goods and services produced within an economy over a given period. Another equivalent definition is that GDP represents the aggregate income earned by all households, companies, and government over a given period. Notice that this corresponds to income and this corresponds to output or expenditure. To ensure consistency across countries and across time, the following criteria are used. The first criteria, and one that we have referred to earlier, is that we only count goods and services produced during the measurement period. So if our measurement period is 2010, then we only look at goods and services produced here. Goods and services produced in the previous year, which might still be available in 2010, would not be counted as part of our GDP number for 2010. The next item, which is important and testable, is that we only count goods and services whose value can be determined by being sold in the market. In the curriculum, this is also referred to goods and services being included at imputed prices. Here there are a few caveats that you need to be aware of. The value of labor used in activities that are not sold in the market are not included over here. For example, the value of labor that gets spent in commuting to work, that is not included. Another point has to do with the value of goods and services provided by the government. For example, the service given by the police or rangers. These services are included only at cost. The reason is that it is very difficult to come up with the market value of the service that is offered by the government. And finally, we use the market value of final goods and services. The definition of final goods and services is that these are goods which are not resold. If you have intermediate goods where company A sells raw material or some intermediate item to B, and then B sells to C, and then C makes the purchase of the final good, we do not count the intermediate goods because their value is included in the final goods. If we included the intermediate goods, then there would be double counting. So in our GDP calculation, we use the market value of final goods and services. Now we come to the important topic of calculating the GDP. Broadly speaking, there are two approaches, the income approach and the expenditure approach. The income approach computes GDP as the total income earned by households, businesses, and the government in a given period. The expenditure approach is based on calculating the total amount spent on goods and services. And there are two ways of coming up with the GDP using the expenditure approach. This can be computed through the sum of value added approach, where GDP is calculated by summing the additions to value created at each stage of production and distribution. The other way is through the value of final product approach, where GDP is calculated by summing the value of all final goods and services produced during the period. Let's look at an example that clarifies this concept. This example is based on material given in the curriculum, and the summary of data associated with this example is in Exhibit 2. This example is based on a very simple supply chain where we have a farmer who sells wheat to a miller for 0.15. The miller grinds the wheat and creates flour, which he sells to the baker for 0.46. The baker then makes bread and sells bread to the retailer for 0.78, and then the retailer sells the end product to the customer for 1.00. Now, let us look at the two approaches for coming up with the total output. In this column, we will look at the receipts at each stage. So we simply copy the data from here. 0.15 is the receipt from stage 1, farmer to miller. Then receipts from miller to baker, that's this stage, is 0.46. Receipts from baker to retailer, 0.78. And then receipts from final buyer, 1. The value of the final output, so this is the value of final output, is 1.00. What about the value added at each stage? At stage 1, the value added is 0.15. At stage 2, the value added is 0.31. This is simply 0.46 minus 0.15. At the next stage, the value added is 0.32, which is 0.78 minus 0.46. And then in the final stage, the value added is 0.22. Notice that the total value added again is 1.00. You can notice that there are two ways of coming up with the total value of output. One is to simply take the value of the final good, which in this case is bread, and that final value is 1, or you can take the sum of the value added at each stage. Now I want you to do example 1, which deals with the same concept but in the context of automobile manufacturing. Nominal and real GDP, and this is an important distinction. When we talk about nominal GDP, we are referring to the value of goods and services at their current prices. Real GDP measures current year output using prices from a base year and eliminates the impact of inflation. To understand the distinction, let's look at the simple example. Consider a country which only produces cotton. In 2010, 1 million tons were produced at 100 rupees per ton. In 2012, the same quantity was produced, 1 million tons, but now the price is 120 per ton. Clearly there is inflation here. The output has not changed. What is the nominal and real GDP in 2012? And let's assume that 2010 is the base year. The nominal GDP is quite simple. It is equal to the current price, so the price in 2012, which is equal to 120 multiplied by the quantity, which is 1 million. So the nominal GDP in 2012 is 120 million. The real GDP takes the quantity in the current year being 2012. The quantity in 2012 is 1 million. But we multiply by the price in the base year. Base year price was 100. So the real GDP is 100 million. Notice that if we look at the real GDP in 2010 and the real GDP in 2012, the number is the same. So in 2010, the real GDP also would be 100 million. So the real GDP has not changed, which is a correct indication of the fact that the output has not changed. The nominal GDP over the 2 years has gone up by 20%, and that increase is purely because of inflation. So in real terms, the output has not gone up. You can imagine, therefore, that to determine whether the output has increased or not, it makes a lot more sense to use the real GDP versus using the nominal GDP. The GDP deflator is a price index that can be used to convert the nominal GDP into the real GDP by removing the effects of changes in price. The GDP deflator is equal to the nominal GDP divided by real GDP into 100. So if we look at the price level or the GDP deflator in 2012, we'll have the nominal GDP, which is 120, divided by the real GDP, which is 100, into 100. So the price level is 120. And we notice that here in our simple economy, the price level is purely based on the price of cotton because that's the only product produced over here. In a more complex economy, the price level will be an indicator of the overall prices of produced goods. Notice that in 2010, the price level would simply be 100 based on this formula, because in the base year, the nominal GDP and real GDP would be the same. So we would have a given number over a given number times 100, which would be equal to 100. The GDP deflator is telling us that over the 2 years, we have a 20% increase in price level. Let us look at a simple example now. you are given the data shown over here and you need to calculate the implicit GDP price deflator in each of these years, and you are supposed to calculate the inflation rate for 2012. So let's do this. Here is what we need to do. As discussed on the previous slide, the implicit GDP price deflator is simply equal to the GDP at market prices, or the nominal GDP, divided by the real GDP multiplied by 100. If we do this calculation, we will get 111.11. That is our price level. The price level is also called the GDP price deflator or the implicit GDP price deflator. Implicit because this is what is implied by the nominal GDP and real GDP. Use the same calculation for 2010, 2011 and 2012 and you get these numbers. Then the inflation rate for 2012. Inflation can be measured by the change in the price level or change in the GDP price deflator. So that is simply 131.58 divided by 125.53 minus 1, which is equal to 0.048 or 4.8%. Now I want you to do example 2 in the curriculum, which is based on the same concept. The numbers are a little bit more complicated, but if you've understood the concept, that's what really matters. We will now look at the components of GDP based on the expenditure approach. The first component is consumer spending on final goods and services. This is often denoted by the symbol C. Then we have gross private domestic investment. This is denoted by I. And note that this is private investment, which means that it is the investments made by private firms, i.e. entities other than the government. This investment amount also includes the change in inventory. For example, if inventory at the start of the period is 10 million and it increases to 15 million, the increase of 5 million is also part of investment. The larger investment though typically would be the investment in property, plant, equipment and so on. Government spending on final goods and services, that is denoted by G. And net exports, this is our external sector, and you can think of net exports as the expenditure by foreigners. Generally this is denoted by X for exports minus M. In other words, if exports equal 100 and let's say imports equal 60, then the net exports number or the net expenditure by foreigners is 40. The three major sectors that we deal with are shown right here. Household and business sectors, this can be thought of as the private sector. Then we have the government sector and external sector. Households will earn a certain amount of money, and from that income they will either consume or save. And I am introducing you to these symbols, which will be discussed in more detail later. The business sector gets money from the financial markets either by borrowing or by issuing equity, and the money is used to make investments. The government sector collects taxes. The amount of taxes collected is generally referred to as T, and then the expenditure or the government expenditure is referred to as G. We need to compare taxes, which represents government revenue, with the expenditure to determine whether there is a deficit or not. If the government expenditure is greater than revenue or taxes, then we say that there is a deficit. A point to note here is that the government also makes transfer payments such as payments to those who are unemployed. These are generally referred to as unemployment benefits. These unemployment benefits are not included in the government expenditure because nothing is received in return for that expenditure. And this is a point I alluded to earlier, where I said that government expenditure, or the money that government spends on items such as unemployment benefit, is not included in the GDP calculation. The external sector refers to trade and capital flows between a given country or a given economy and the rest of the world. A balance of trade deficit, or what is generally referred to as a trade deficit, means that a given domestic economy is spending more on foreign goods relative to how much foreign companies are spending on domestic goods. So if we come back to this example, you have a given economy and here is the rest of the world. Let's say that the money that is spent by this economy on foreign goods, which is represented by imports, is equal to 100, and the rest of the world is paying 80 over here. So this would represent export of goods to the rest of the world, and the rest of the world paying 80 to the particular economy. Here we have a trade deficit because the exports number is lower than the imports number. The earlier deficit related to government expenditure and taxes is referred to as a fiscal deficit. There will be more on this material later. Exhibit 6 in the curriculum combines the various items that we are talking about. Notice that we have three markets, and we talked about this in the very first reading in economics. We have the factor market, the goods market, and financial markets. Through the factor market, households provide factors of production to firms. Factors of production would be land, labor, and capital. In return, the firms pay households. The income is coming to the households. Now, what do households do with the income? There are three ways in which the income can be spent. One is consumption. Households go to the goods market and buy, so that is consumption. Households pay taxes, so the net taxes paid to the government, let's say denoted by T. And households also save. So money put into the financial markets is essentially money saved and denoted by S. Firms borrow money from the financial markets, and I say borrow, but firms could also raise equity capital from financial markets, and that money is used for investments. The government buys goods and services from the goods market. As mentioned earlier, if there is a difference between revenue, government revenue, which is taxes, and government expenditure, then the government will need to borrow money. Government borrowing, in the case of a fiscal deficit, will happen through the financial markets. So this arrow represents government borrowing. And finally, we come to the external sector, where we will have both exports and imports. So that is denoted by X minus M. Now this picture summarizes all the components of the GDP, and that is done right here around our goods market. The summary expression for our GDP then becomes the following. GDP is equal to consumption plus investments plus government spending plus net exports, or X minus M. And this is an important relationship to remember. Section 2.3 GDP, national income, personal income and personal disposable income. This section is based on numbers presented in Exhibit 9 and those numbers are related to the Canadian economy. If you have the curriculum handy, you can look at the numbers, but you can also understand the concepts presented here without having the numbers in front of you. For the various years shown in the exhibit, we can calculate the GDP based on the expenditure approach, and the definitions used by the Canadian government are slightly different from what we have talked about so far, but it is easy to see the parallels. So when we talk about the expenditure approach, remember we said earlier that the GDP can be shown as consumption plus investment plus government spending plus X minus M or net exports. Now let's look at the definitions used over here. Consumer spending on goods and services, that clearly is the C that we've talked about. Business gross fixed investment and change in inventories. Remember, I alluded to this a short while ago. The combination of these two is the investment number, which we mentioned here. Government spending on goods and services and government gross fixed investment. So all that is being done here is that the G or government spending is being broken into two parts. So collectively these two items are G, and then we have exports minus imports, that is this part of the expression. We also have a statistical discrepancy which I'll talk about in a little while. Now coming to GDP based on the income approach. Here we have the national income plus something called capital consumption allowance and again statistical discrepancy. The big item is national income. And national income is a combination of these items. Again, we've talked about the four categories of payments before, and you'll notice that these items are fairly similar. Compensation of employees. So these are the wages paid by businesses to employees. That's fairly straightforward. Corporate profits before taxes. This would include the dividends, retained earnings, and the taxes. Notice that with this item, we have not paid the taxes yet. Interest income is fairly obvious. Unincorporated business net income, this refers to the income or the profits of entities that are not incorporated. So if you have a small farmer and he has a profit, that would be shown over here. Then we have rent, and then finally indirect business taxes less subsidies. So this is the amount that effectively goes to the government, the taxes less subsidies. You need to remember this definition of net income. Coming now to capital consumption allowance. This is also referred to as CAA. This is a measure of depreciation. In other words, the capital stock or the equipment that is used over the year or over the period where we are measuring GDP, obviously the capital stock, obviously there is wear and tear associated with the capital stock, and the monetary value of that wear and tear is depreciation, or in this context it is called capital consumption allowance. By including this term, we are acknowledging the fact that some of the income needs to be spent on replacing or maintaining the capital stock. And now finally, statistical discrepancy. This is not typically a large item, but the point is that theoretically both these approaches should give us the same number. But practically we often end up with different numbers because different data sources are used, and the plug item or the item we use to make these two equal is the statistical discrepancy. Most governments report a figure called personal income for their economy. Personal income is a broad measure of household income and measures the ability of consumers to make purchases. Personal income includes all income received by households, whether that income is earned or unearned. And let us see how we come up with this number. The starting point is the national income, which we saw on the previous slide. But notice that the national income does not all go to households. So we have to subtract the indirect business taxes. The taxes go to the government. The corporate income taxes also go to the government. So these are subtracted. Undistributed corporate profits. Remember, the corporate profits that we talked about on the previous slide also included retained earnings. Retained earnings do not go to households. Retained earnings are retained by the businesses. So we subtract undistributed corporate profits or retained earnings. And finally, any transfer payments that are made by the government to households. This would be unemployment benefits, for example. This number is added. So we have our overall personal income. But notice we have not subtracted personal taxes. Therefore, a more useful number to look at would be what's called personal disposable income. This is equal to personal income tax. This is equal to personal income minus personal taxes. If you have time and if you have Exhibit 9 in front of you, then work through example 3. This is a fairly long example. It is unlikely that you get something like this in its entirety on the exam, but the concepts contained in example 3 are important and useful. From an exam perspective, you are more likely to see something like this. Let's say you are given this data and you are asked, what is the GDP and national income for 2012? And we assume these are all 2012 numbers. So do this before looking at the answer. Here is what you need to do here. The GDP is based on the relationship that we've seen several times now. So the overall GDP is consumption plus government spending plus investment plus X minus M. You plug in the numbers and what you should get is 452. Then based on what we just saw, the national income should be equal to GDP minus CCA. This is the depreciation number minus the statistical discrepancy. Plug in the numbers and you should get 412.